Hey, Dan Passarelli here. Often people talk about diagonals, and I thought I'd take a minute just to talk about, well, exactly what they are. So, a diagonal is actually a really broad category of potential option strategies. Basically, if you think about what a vertical spread is, it's when, if you look up at this chart right here, it's trading two options at two different strikes. So that's vertically, right? A horizontal spread is another name for a time spread, and that's just across different expirations, right? You buy one option, one expiration, one option, and sell an option, a different expiration, same strike. So a diagonal is just a combination between vertical and horizontal, two different strike prices and two different expirations. Now, that could mean two puts. I could be buying this put here and selling this put here at a different strike price and a different expiration. But most commonly, it's done with calls. Specifically, buying a longer term call that's in the money and selling a shorter term call that's out of the money. A lot of people will refer to this as the poor man's covered call because basically what it is we're using the longer term big delta option as a substitute for owning the stock and then selling calls against it. An example of that would be like buying these June 21st 170 calls and at the same time selling these June 7th 182.5 calls. And if you look at the risk profile of that, you see it does kind of look a little bit like a covered call shape, except we have a little bit of curvature to both of the lines here, particularly this line here, because we have limited loss by owning the bigger delta call, whereas if we own the shares, we'd still technically have limited loss, but it would be a lot more significant. So that is what diagonals are. That's how they're most commonly traded. I hope that helps. This is Dan Passarelli, Trade Smart.